Ever wonder how crude oil, currencies, bond yields, and the stock market interrelate in the complex world of finance? Picture these four as the cornerstones of a global financial market. Crude oil, the black gold that powers economies. Currencies, the lifeblood of global exchange. Bond yields, the interest connection that links investors to the future. And the stock market, an economic mirror reflecting the health of corporations. Dive in with us as we unravel the intricate relationships that bind these financial elements together. Crude oil, often referred to as black gold, holds immense influence over the global economy. This thick, dark liquid is more than just a fuel source. It's a driving force for economic growth, and its price can set the tone for markets worldwide. Picture this. When crude oil prices rise, it becomes more expensive to produce and transport goods. This can lead to a surge in general price levels, a phenomenon known as inflation. But that's not all. Higher oil prices can also slow down economic growth as businesses grapple with increased costs. Now here's the twist. Inflation and economic growth are two crucial factors that influence the value of currencies and bond yields. When inflation rises or economic growth slows, central banks may adjust interest rates, causing currencies to fluctuate and bond yields to shift. So we see how crude oil, acting as a key economic indicator, sets off a ripple effect that touches every corner of the financial market. Moving on to currencies, these are the lifeblood of global trade and investment. They are the medium through which countries exchange value, driving the dynamics of global commerce. Now let's consider the relationship between currencies and crude oil prices. When the price of crude oil changes, it creates ripples that touch every corner of the global economy. A country that exports oil, for instance, may see its currency strengthen when oil prices rise. Why? Because higher oil prices mean more revenue, which can bolster the country's economic health. On the flip side, countries that import oil may experience the opposite effect. Higher oil prices can lead to increased costs and potentially economic stress, which can weaken a country's currency. These are just a few examples of how the interconnected nature of our global economy means that fluctuations in the price of a single commodity like crude oil can have far-reaching impacts. As we can see, currency values don't exist in a vacuum. They're directly influenced by the health of the economy and the price of crude oil. Switching gears to bond yields, these are the interest rates tied to bonds or debt securities. Now, let's think of bond yields as the heartbeat of the economy. They rise and fall in response to changes in economic conditions and shifts in currency value. Let's take a simple example. Suppose inflation starts to climb, driven by a surge in crude oil prices. This increase in the cost of living can lead central banks to hike interest rates in an attempt to keep inflation in check. And as interest rates go up, bond yields follow suit. The reason? Well, new bonds issued would now pay a higher interest to attract investors, which in turn increases the yield. This makes existing bonds less attractive, unless their price drops to match the new higher yields. The bond market, therefore, is a reflection of the economy's health, showing the ripple effect from crude oil and currencies. Last but not least, the stock market, often seen as the mirror of the economy. This economic mirror is not isolated, but influenced by a myriad of factors we've discussed before. Let's break it down. Firstly, crude oil, the black gold. When oil prices rise, it increases the cost of goods and services, which can hamper company profits, causing stock prices to dip. Conversely, lower oil prices can boost profits and lift stock prices. Next, we have currencies. Changes in currency values can significantly impact multinational companies. A stronger home currency makes overseas earnings less valuable, which can be a drag on stock prices. Then, the bond yields. Higher yields can make bonds more attractive, drawing investors away from stocks. This can lead to a drop in stock prices. Therefore, the stock market is a culmination of all these factors, reflecting the complex interplay of crude oil, currencies, and bond yields. In conclusion, the financial market is a complex web of interrelated elements. Crude oil, fondly called black gold, significantly influences our economy, causing ripples in currency values across the globe. These fluctuations, in turn, connect to the ebb and flow of bond yields, painting a vivid picture of our economic health. And finally, the stock market, acting as an economic mirror, reflects these intricate relationships. Understanding these relationships not only demystifies the financial market, but also gives us a broader perspective on the global economic landscape.